Greetings, and welcome back to the podcast. This episode, we are joined by Mr. Joe Raia, Chief Commercial Officer of Abaxx Commodities Futures Exchange and Clearinghouse, a new Singapore-based futures exchange that is a wholly owned subsidiary of Canadian-based Abaxx Technologies, a CBOE Canada-listed technology company that aims to build tools for better commodity benchmarks for the energy transition. Mr. Raia is a former Managing Director, Head of Global Commodity Futures at Goldman Sachs, and Global Head of Energy and Metals Futures and Options at the CME and New York Mercantile Exchange. Mr. Raia also holds a Bachelor of Science degree from SUNY Maritime Academy and was a licensed U.S. Merchant Marine Captain. Among other things, we discuss building a new commodities exchange, the importance of futures contracts, and the investment case for LNG. Enjoy. This podcast episode is sponsored by Conate Water Solutions. Do you need cost-effective water sourcing options to supply your next drilling or completions program? Conate Water Solutions is a specialized hydrogeology company focused on water well drilling, testing, and water management services in Western Canada and Texas. Contact info@conatewater.com or check out conatewater.com for more details. This podcast is sponsored by headracingcanada.com. In partnership with four-time Olympian Manny Osborne Parody, headracingcanada.com is now offering free shipping on European factory performance ski gear. By passing brick-and-mortar savings on to customers, headracingcanada.com offers the lowest pricing available in Canada. Check out headracingcanada.com for more info and get your new ski gear for the season. Good morning, Mr. Joe Raia. Thank you very much for doing this. I really appreciate your time.
Looking forward to it. You can highly recommend it.
Well, thank you. For the listener, you are the Chief Commercial Officer at Abaxx Technologies. But for anyone that is listening, what is Abaxx Technologies?
Well, Abaxx Technologies is a publicly traded company on NEO Canada, but it's also the parent company of Abaxx Singapore, which is the holding company for Abaxx Exchange and Abaxx Clearinghouse, the newly regulated clearinghouse, futures clearinghouse and exchange under the MAS that is based in Singapore.
If you were to explain it to your grandma, maybe in simple terms, what would you say?
Futures markets are hard to explain to people that even understand markets, but a futures exchange in general is a marketplace where risk is managed. Generally, it has been or traditionally has been in markets, in commodity markets, and actually started out in both New York and Chicago back in the 1800s where farmers were hedging risk on delivery risk and price risk on materials like butter, milk, wheat, mostly farming type products, which both exchanges were both the NYMEX and the COMEX on the metal side, and the Chicago Board of Trade and the CME were really the two big institutions that started the futures markets and the real focus on mitigating risk or hedging risk in commodities, whether you can manage your price risk by selling out. And this is the hard part to explain to your grandmother probably, but to look at a farmer who's trying to manage his cost on producing wheat and the price that he sells it to the consumer on, where if he can lock in a price at a certain time and then deliver the wheat, then that's a win for him, right? So he can manage both the input cost and the output cost. Same on a refiner, right? A refiner has feedstock, which is crude oil generally. If he can hedge that side of it by controlling his input costs, and then when he produces, whether it's gasoline or jet fuel, then go to a buyer and lock in a price for that product on a particular side, and that spread would be his profit. That is a way to manage that input cost, output cost, and also the ultimate sale of the product. So in very, very simple terms, that's generally how it works in today's world. Futures markets and commodities specifically are very complex, involving options. It's mostly institutional traders, or at least the exchanges like Abaxx or CME or Intercontinental Exchange are generally institutional exchanges where the firms that are trading those products are highly sophisticated, right? And the risk that's associated with trading those products is made known to the customers at the outset. So it's not somebody that's going to generally open up an account at Fidelity and trade one lot of crude oil or one lot of Abaxx LNG. That risk is quite substantial, and the middle and all the associated costs that go along with it is something that's just not for retail investors.
For the purposes of today's conversation, I thought we could structure it in two halves, get into Abaxx a little bit, Abaxx Technologies, and then maybe get your thoughts on LNG and some of the current events surrounding that. But to rewind the clock a little bit, to get back to the beginning, how did you get into energy and commodities and futures? And I think you spent some time with Goldman Sachs.
I did, Trevor. And winding back the clock goes back to my time in the U.S. Merchant Marines. I sailed on oil tankers for about 7 years, and got involved in energy markets after that from a trading perspective and brokering perspective, and went to the NYMEX in late 01, early 02 to work on a clearing product for the OTC energy markets in the U.S. that was developing as a result of the Enron default. So so my commodity experience went into exchange experience by spending 12 years at the NYMEX and then the CME after the merger. I was involved in a lot of the product in a very short period of time there, as far as launching the Clearport platform, which involved bringing in not only just U.S. markets, but eventually global markets in OTC or non-exchange traded instruments or derivatives that needed credit mitigation. So again, going back to my original description, the exchange is the risk management tool for the marketplace. And so we were taking that risk management tool or the exchange and clearinghouse and bringing that to the over-the-counter energy markets globally. That's something that developed into almost listing 2,000 contracts on the exchange. The revenue that was generated by that and by the clearinghouse attracted the CME, which ultimately merged with us. But even in the interim, we launched other exchanges like the Dubai Mercantile Exchange, which was the first sour crude benchmark east of Suez that was listed as a futures contract that's still out there today. The Green Exchange, which was Carbon 1.0, which really looked at the mitigation of risk in environmental markets back in the mid 2000s, and then quite a few other instruments products that we listed on exchange. We merged with the CME in 2007, and I stayed at the NYMEX and CME through middle of 2011, where I moved to Goldman Sachs and looked after the commodity clearing side of the business, growing their customers on specifically end users in commodity futures for Goldman. And then came here in 2019 to join former colleague of mine from the NYMEX, Dan McElduff, who's our president of the exchange, and Josh Crum, who is a founder of Abaxx Technologies and was the head of metals research at Goldman during my time there, also in London. So yeah, so it's that's how we got where we are. We started the project, now it's almost 5 years ago, looking at LNG as a non-benchmark product in the marketplace. And the LNG markets were moving from almost exclusively very long-term products or long-term agreements into a lot of optimization of those contracts, but also a lot more spot trading in the LNG market as the U.S. became arguably the largest producer of LNG. A lot of those molecules were not tied to term contracts. The marketplace was looking for a way to hedge the risk, the price risk of those molecules on the water. Really, to this day, there is not a physical benchmark in the futures markets for waterborne LNG deliverable anywhere, whether it's FOB, US Gulf, Northwest Europe, or Asia. And we started work on that again almost 5 years ago to work with the marketplace, trading community, the brokers, the banks, to determine what is the instrument, what does it look like, how do we take the terms of an OTC instrument and turn them into a futures contract. And so with a lot of interaction with the marketplace, the products that we'll be listing when the exchange goes live here in just a very few short weeks will be 3 physically deliverable LNG benchmarks, futures benchmarks, which don't exist today. So it's unique. It's needed in the marketplace to mitigate not only price risk, but delivery risk, but also to give the LNG global community a pricing instrument that they can look at for both hedging their risk, but also financing projects like it's normally done in with futures contracts.
At the end of the day, Abaxx is a business. Getting back to your grandma, how would you explain the company makes money and earns a profit?
Yeah, it is a business, Trevor. And it's a business that the model that a lot of people don't understand. Again, when you look at the global community of exchanges and clearinghouses, certainly exchanges are probably a lot more in abundance than clearinghouses. It's a lot easier to set up an exchange only. The clearing is the part that is the difficult part, right? It involves capital, it involves risk, it involves risk systems. There's a reason why there's only a handful of them, and we're now the first one licensed and built from the ground up in over a decade, if not longer. And the reason for that is it does take time and money. We've spent over $50 million in 5 years developing it. And it's just because it does take that long to get everything moving in the right direction, products, risk systems. How we make money? We make money on repetitive trades, right? So we list products, and every time a product is traded from the buy side and the sell side, we collect a clearing fee from that product. It's very transparent. Our fees are listed and will be listed on the website. The revenue we generate is generally very high margin. If you look at the cap structure of the existing exchanges and clearinghouse, you're looking at margins, in the 65, 70, 75% range, very, very high, right? So our sunk cost in the clearinghouse and the exchange has already been done, right? We're already at that point. So for us to list, and that's where the clearinghouse is the crucial part of the business model. Once we have built the clearinghouse, have built our systems, they're being accepted by not only our regulator, the MAS, which they have, but also now clearing firms, which we today, literally this morning, just announced our first clearing firm as a member of the exchange and clearinghouse. Once they go through the due diligence of certifying that our systems are up to their standards, from a regulatory and a clearing member perspective, we start bringing in customers to trade the products. We're able to bring in new products to list on the exchange. And going back to my original description of the NYMEX, when I was there, as I said, I listed almost 2,000 products there. And those were based on customer interaction to us, which generated significant revenue for the NYMEX back in the day. Once the clearinghouse is built and established and regulated, we can now list new products as the marketplace asks us. We'll start off with 3 product verticals here in LNG, nickel sulfate in the battery metal space, and carbon. There are quite a bit of inbounds already from firms that are looking for other asset classes that haven't been addressed by the existing exchanges. And again, that's how we make our money, right? That's how we generate revenue, continue to stay linked with the marketplace by listing those products that they ask for that will help us generate revenue and also help them from a risk management side in the marketplace.
This may be too simple, but sometimes there's counterparty risk. How does Abaxx deal with that aspect of your parties can't pay in simple terms?
Yeah, counterparty risk is managed and mitigated by clearing members, right? So in the ecosystem of futures exchanges and clearinghouses, the clearing member is an integral and critical part of the risk management waterfall, as people like to call it, or risk train, right? So there is the clearing firm, and I'll use Goldman Sachs as the clearing firm, or StoneX, which is our first clearing firm here on Abaxx. StoneX will get interest from their customers to gain access to trade our products on exchange, whether it's LNG or nickel sulfate or carbon. StoneX does the due diligence with that customer to say if they are creditworthy, if they have capital. They look at their financials, they look at their risk profile, and they'll then permission them through our system, as long as StoneX is a clearing member of Abaxx, to trade and gain access to our products. When that customer trades a product, it goes through the clearing member into the exchange, it gets executed on the exchange, and then the data flows back to the clearing member, which then goes back to the customer. And that data includes, obviously, time and sales, volume, settlement data, the margin, the exchange futures margin that's required from trading that particular instrument. And so the clearing member really is the first line of defense in the risk and the risk management of futures exchanges and clearinghouses and clearing members and all the members of the exchange. So if StoneX is one of many clearing firms, they have to obviously make sure that their risk systems are up to par so that there is no inadvertent risk added to the other clearing members of the exchange. Sounds complex. It is, but it's the risk model. And then our systems on exchange have to be obviously super ingrained into what the clearing members are doing to understand their customers' positions, what kind of risks they're putting on their book, and not only from that one clearing member, but the other clearing members that are part of the exchange.
And things are going pretty well for Abaxx. If I'm correct, Jeff Curry recently joined the board, a previous Goldman energy analyst. You've had some good investment from companies like Canoe Financial up in Canada.
Yeah, it's having Jeff join us was a fantastic coup. I was very familiar with him and knew him well during my time at Goldman. We utilized him for customer interaction quite extensively, but also Dave Greeley, who's our chief economist, was also one of my colleagues at Goldman. He actually ran energy research under Jeff Curry during my time when I was at Goldman also. And Dave joined us about 4 years ago now, almost 4 years ago now, and has been an incredible asset for us to use him to help educate our customers on macro themes in the marketplace, educate them on our products. And we see Jeff as being the same, that same tool in the toolbox for us to use. Although probably he opens up a lot higher level doors than all of us combined, but his relationships in the marketplace are fantastic. To have him and all of our board members are just, have been picked for a lot of various reasons, but mostly because of their relationships in the marketplace. And this business is a relationship business, and it's it's one of the most important parts of our model is building relationships, existing and using them, and having Jeff and David and our other board members very active with us does help us grow our marketplace, grow our product ideas, and ultimately grow value for our shareholders.
On one hand, you need a market for instance LNG futures, but on the other hand, the critic would say certain exchanges promote speculative behavior. How does Abaxx get around that and mitigate that aspect of markets when futures are involved?
Yeah, that's a great question, Trevor. And I've dealt with that for all my years at the NYMEX, and I'm sure it was well before I got there. And I'm sure it continues afterwards. The role of the speculator does have an importance in the marketplace. If everybody was just a buyer or a seller, you wouldn't have the ability to manage price risk. You need speculators, and we had them on the floor of the NYMEX or other open outcry exchanges when open outcry existed. The locals, as they were called, were the market makers or the speculators at the time. And they took, they took both sides of the marketplace in order to facilitate market flow. So yes, there is a role for them. There is also an importance for overseeing that role to make sure that there is not disruptions in the marketplace based on their participation in trading and buying or selling. So, I could say pretty comfortably that the systems that we have now, even back then at the NYMEX, are able to monitor the activity of all trading firms that are involved with us, whether they're commercials, banks, or speculators, so to speak. But when you look at the participants in commodity markets, again, they're mostly institutional clients. You will have some market makers or whatever they are, market makers that are maybe high frequency trading firms that will be a part of our marketplace eventually. But they also trade block trades too. They provide liquidity in block markets, which will be probably a good I would say a good percentage of the volume and execution of our initial trades will be as blocked. And they will also those market makers will provide an important role in developing liquidity in those marketplaces.
What characteristics of a good exchange prevent it from being one giant casino? Do you think of it that way?
I think of it as, again, it's having the best risk management and oversight systems. It's understanding your customers and what they are trading and what they need to trade. If a particular customer on exchange has a small position in futures, but has a massive position in the OTC unregulated marketplace, that just brings more risk, not only to themselves and their counterparties off exchange, but also even on exchange. So we need to understand our customers. We did this at the NYMEX back in the day, where our compliance group was extremely well versed in discussing with customers, how big is their OTC position versus their futures, right? That's really how you manage risk. You can't just look at it myopically in the positions they may hold on our exchange or even other exchanges. And I think those are things that the marketplace is, I think, needing, especially when prices of commodities are so high, like we had a couple of years ago, where the margin calls on futures exchanges were so massive, was putting stress on clearing firms, exchanges, trading firms. The amount of margin that they had to post was massive, yet there was no netting of that margin potentially against the risk that they may have had in the OTC markets. And I think that's something that, not to get down the technology rabbit hole too much here, but there is an opportunity for a better use of margin and collateral in commodity marketplaces by looking at the OTC positions that may have a good spread against a risk management spread against the futures markets and be able to net that or make more efficient use of that collateral.
Maybe this is a good segue into LNG, but it's a fine line between speculation and investment. But one of the jobs of the speculator with a tool like an exchange is to, I guess you could say, initiate the progress of the LNG markets. How important do you think Abaxx is into the development of the LNG markets? Just having an exchange, for instance.
Well, to have an exchange in a clearinghouse to list a physically deliverable contract is really the difference, right? It's something that the existing exchanges, and I would say if you go back to the days when we launched Clearport, we moved from a physical market back then, both predominantly physical futures contracts market, for dozens and dozens of years. NYMEX only had roughly five physical contracts. When we started listing contracts on Clearport, we went mostly to financially settled markets because there were benchmarks already in place, like Henry Hub, WTI, Brent crude oil on ICE. So the listing of financially settled contract using indexes from various price reporting agencies was what the marketplace was asking for. In this instance, we see the turnaround of that, where there is no benchmark in LNG, global benchmark in physical LNG. The use of price reporting agencies to settle markets is something that, and it's not only in LNG, we hear it even in nickel sulfate and the battery metals, that there are just too many financially settled products out there, and the method by which they settle those products, meaning they go and call a marketplace and ask the trading firms what they think the price of the market is, just doesn't lend itself to a regulated marketplace where the actual trade of the commodity is the settlement of the product. And so that's really the difference. And you can't settle that market unless you have a physical benchmark. And without having one in LNG, and with all the product that's coming on the water now, I mean, if you look at the actual flow of LNG out of the U.S. Gulf alone now, we're over 100 cargoes a month. And back 2-3 years ago, there was less than a handful. So where are most of those molecules going? They're going everywhere. A lot of it to Northwest Europe, some of it to South America, some of it to Asia. But still, if you're taking delivery of an LNG cargo in Japan, say, as a utility, chances are that pricing of that LNG cargo is based on Brent crude oil in Europe. It makes no sense whatsoever. And that Brent crude oil in Europe, which is pretty much non-existent from a production perspective anymore, is also including U.S. crude oil. It makes zero sense. It has zero correlation. And we really feel that the marketplace is going to grasp the LNG futures contract and use that as a de facto pricing benchmark for their waterborne cargoes.
Well, to transition to LNG, recently the U.S. announced a moratorium on further developments in the States, but from a Canadian perspective, I'm Canadian. Do you think this presents an opportunity for Canada to catch up? How are you thinking of it?
It seems more, and if you look at some of the pundits out there, and I'll leave the arguments to them, but just from taking a step back, it seems more political than practical. Certainly, LNG is proven to be an energy transition fuel, not for just now, but for the future. And it's an important part of the hydrocarbon stack, so to speak, that we're going to need for the foreseeable future. I don't think anybody with any sane mind would say like we're just going to throw hydrocarbons out the window tomorrow. Certainly, Canada has an interesting and important place in the global role. I was up in Vancouver last year for an LNG conference, and the amount of trading firms that were up there, talking to the Canadian potential exporters of LNG was quite amazing. We see our contract as potentially being usable for Canadian LNG, for hedging of Canadian LNG ex the West Coast. So that's something that we'll look at down the road to educate customers on how they can use our futures contract as a benchmark pricing instrument for that export cargo out of Canada. Same for Mexico. Mexico is going to start exporting through a terminal down in Mexico that would be able to use our product for a Pacific delivery, either FOB or export contract out of Mexico. So there's definitely a role. I don't think that this moratorium will last. I think it'll be the market, and it's apparently not going to happen until 2027. So there's a lot of time between now and then, and I think there'll be a lot of pressure for the U.S. to reverse that. Given some of our allies are very much dependent on our exports of LNG, whether it's in Asia or in Europe.
The idea is that the route from Canada to Asia is relatively short. Do you think that will help the Canadian case for LNG?
I think that case has been made. And I think if you talk to when you look at the optimization of cargoes, which is what we're seeing now, right? I think the optimization of those, before 5-10 years ago, LNG was on a railroad track. It was basically going from load port to discharge port, and the ship would turn around and go back down empty and load. Now you're seeing triangulation or optimization or arbitration of those marketplaces globally. I think certainly the Suez Canal issue is even forcing firms to rethink globally, what they're doing now, even before Canadian LNG comes on the water. So yeah, it'll be an important. I remember back in my days when Alaskan crude oil was finally allowed to be exported out of Valdez to Japan, and that was a big deal because it was such a shorter route than the route that it was taking from Valdez all the way around to the U.S. Gulf. So again, that's optimization, and energy firms, big multinationals or trading firms or whatever, are always looking to arb or to maximize their profits, obviously, but also to maximize the routing of their product and their crude oil or LNG. So yeah, that's going to be an important part of the marketplace once it comes on the water.
You have experience in a lot of commodities and that sphere in general, but it seems like LNG has been one of the focus areas. Do you see the most opportunity in that commodity going forward, maybe from Abaxx's perspective or just commodities in general? Do you see a lot of opportunity around that?
We do, Trevor. LNG obviously is our flagship products, and but yet from that comes inbounds from customers. The battery metals development with nickel sulfate came to us from BHP now probably almost 2 years ago. They reached out to us after the LME issues on nickel, on Class 1 nickel. They asked us, they said, Abaxx, you weren't our first call. We called the other guys first, and there wasn't a positive response in looking to develop something. And nobody knew at that time what the product would be. But we said, yeah, we're interested. We can obviously fit a nickel sulfate contract under our clearinghouse arrangements. It's not a difficult thing to do. The important thing is to go out and engage with the marketplace and understand what they want. So we hired one of the senior nickel traders at Glencore, and we started doing due diligence in the marketplace. And based on his relationships and our interaction with the marketplace, came up with kind of like taking the top of the funnel and pushing everything in. And what came out of the bottom was really, as a collective agreement with the marketplace, was nickel sulfate. That's what really that everybody was looking to utilize to hedge their risk in manufacturing of batteries, mostly for EVs. The Class 1 nickel on LME was a different type of product, but the actual nickel sulfate product doesn't exist from a hedging perspective, and as a physically deliverable product. And so that will be our first battery metals, transition energy metals product out the door. But from that has come already additional discussions in other battery metals that are needed from the physical side. Again, there are a lot of financially settled index products, but we kept hearing over the past couple of years that the marketplace doesn't need another index product. They need a physically settled futures contract. And that's where we think we're on the right side of the discussions with the marketplace from developing that.
The debate is between LNG, which is a displacement of carbon intense coal, and on the other side, people who want clean energy, so to speak, with solar and whatever else you want to put in that category. Do you view energy as a solution to carbon intense coal? And how do you think of it that way?
It's well, you have to look at it as one of the solutions, right? And I think the word energy transition is for LNG has been now really maybe changed a bit more to being energy solution. The marketplace, global marketplace, understands that LNG is an incredibly important part of the hydrocarbon stack. Again, we're not going to get rid of them tomorrow. I think a lot of people wish we could, but we can't. And so if there needs to be a solution, both interim and long term, LNG is certainly one of, if not the most important part of that solution. Certainly renewables, both in solar and wind are important, but it's been proven, I think, over the past few winters that you can't rely on just that. So there's going to be need of a mix. Certainly coal is an issue from a pollution perspective and carbon perspective. But when you look at Asia still, how many of the big cities in Asia, and I think Josh commented on this, and I don't want to misstate some of the numbers he gave, but Josh Crumb, our CEO, was basically talking about on a Bloomberg interview recently that so many big cities in Asia, the large percentage of their power generation is still via coal, right? And that's really where the change has to be, and that's also where LNG can play an increasingly important role in that transition from coal, away from coal to LNG.
The worry is that because I guess natural gas is a commodity, although LNG opens up markets to mispriced opportunities, that eventually the price will just fall back down again to the lowest cost producer and the marginal cost of supply. Do you think that LNG really opens up markets that are sustainable? For instance, Canada, would it be able to access consistently higher prices, or how do you think of it that way from a supply and demand perspective?
Well, putting my exchange hat on, we're not really looking to say the price is too high or the price is too low. We just want to provide the forum and the venue to mitigate both the buyers and the seller risk in that price, whatever it is. But we've seen, during my days at the NYMEX, we saw prices in natural gas go from $1 in MMBTU to $13 in MMBTU in a day based on events in the marketplace. So yeah, it was 13 too high. Certainly, that price went parabolic. But is one too low? And I mean, that's up to the marketplace to determine. It's up to us as a regulated marketplace to allow the efficient transfer of that risk on exchange, so that both buyers and sellers of the high price and the low price can be managed in that venue and managed in a way that doesn't jeopardize the clearing members of the exchange and all of the other trading firms. So I wouldn't want to give my opinion on whether the price is too high or too low. And certainly us as an exchange and a regulated marketplace really just provide that forum for that transfer of risk and price risk and counterparty risk on the exchange.
A question from Twitter, Mr. Arjun Murti. The question coming from Mr. Murti is, how does LNG get to a net zero state, and or is that possible?
Yeah, that's Arjun is one of the OGs in the research side of the business and highly respected and also a good friend. So I'm surprised that he asked that question of me. But I would say that there has been attempts to publicize from some of the majors carbon neutral LNG cargoes, full cargoes. I think there's a very complex structure of the measuring and verification of what that means. I think there's been a lot of pullback from the publicity side of it. So there's no telling right now if there still are carbon or LNG cargoes that are offset with carbon projects, with voluntary carbon market projects. To do it, though, does require the measuring of and the measuring of the footprint literally from the wellhead, which is scope 1, down to the liquefaction terminal, down to the transportation on the LNG carrier, to wherever they're going, to the ultimate discharge port, and where they utilize that gas, whether it's in a power plant, a manufacturing plant. If they resell that gas, that's really the hard part from determining what that footprint is, right? Scope 1, 2, and 3. If it's going from point A to point B with really no kind of changes in the middle, maybe it's a little bit easier, but still to put your hand up in the air and say this cargo is carbon neutral, it is very difficult to determine that. We've attempted through our platform that we'll be launching, and we'll have a calculator involved in it to calculate the the footprint of that cargo from point A to point B, not necessarily taking into account scope 1 and scope 3, but certainly in that transportation piece of that futures contract, what does it need to go from point A to point B? But again, the carbon markets have been started out with a lot of great intentions. I think over the past couple of years, we've seen the issues around the actual measuring and verification of voluntary carbon markets, voluntary carbon projects. And I think that in order to get that marketplace back to what it was intended, was really to reduce the global carbon footprint, is really to make sure that these projects, whether they're environmental projects or cook stoves, or whether you're talking about renewables, do what they're intended to do, right? And so, yeah, can you try to say put your hand in the air and then say it's carbon neutral cargo? Possibly, but that's all that lies in the beholder, basically, right? That viewpoint. And so, I think again, we're here, but we're going to be listing a voluntary carbon market. We think it's a different product than what's out there again. And so we think it will be utilized by firms that feel that they still need to manage their carbon footprint, whether they're a trading firm or a multinational energy company. And so, our job is to provide those tools to make sure that what we list for trading and list for risk management are really the tools that the firms want, right? Not to say that we're trying to force them to trade it, but what they really have helped us develop and said to us, hey, we think you have a different model. We think that Abaxx can provide a different product than what's out there in the marketplace now.
Maybe just to back up a little bit, but back to the U.S. moratorium, one perspective from Canada is that it's an opportunity, but do you think it's a zero-sum game between the U.S. and Canada, and that if one gains, the other loses, or is there enough room in the pie in the market?
I think there's plenty of room in that pie, Trevor, and we just continue to see the increase in exports in the U.S. side, and I think the Canadian exports are just going to be another opportunity, going back to my optimization point earlier, to be able for firms to optimize their portfolio in LNG instead of taking a ship on a railroad track back and forth, right? To find ways to best optimize that portfolio.
And if you were to view the whole LNG opportunity, if you were to zoom out, what inning or how much opportunity is left, do you think?
I think there is a lot of opportunity left, whether it's Middle East exports, Canadian exports. The opportunity is, I think, still early innings. I think if you talk to exporting firms, producers, receivers, there's still an incredible opportunity. Again, going back to my earlier comment, if you look at the Middle East, if you look at Asia and the predominant populations that are still being supplied by coal-fired power plants is just massive. You look at India, right, which really has hardly any LNG production or power production or import facilities. There's still an incredible opportunity for placing LNG globally in the marketplace, where it would certainly push out coal-fired plants.
And from your perspective, who wins in that scenario? Is it the supplier of the product? Is it the service providers? Who captures the most value in that chain?
It's a good question. From a value perspective, certainly the producers will capture some value. It's interesting that when you look at the price of Henry Hub in the U.S., right, which is domestic gas, pipeline gas, you're still at a two-handle, right? A two-handle and change. And it's been arguably at that level for years. With all the exports that we're now facilitating in the U.S., again, back to my earlier comment of over 100 cargoes a month, which will also increase by 20% this year, you're still looking at it, 2 to 3 handle, 250 and then BTU. The marketplace is saying, as a producer, how does that producer, how the producers of that gas capture value? Well, they obviously are. So there's some cost in whether it's fracking or traditional drilling is already in place. Sorry. And so there is an opportunity for them to continue to produce, knowing that gas can either be consumed internally in the U.S. or now exported to Europe or to Asia. But when you look at the landed cost of LNG in Asia, you're now at a lower level that we've seen in the past, the lowest level we've seen in the past few years, and same in Europe. So as long as there's demand there, and as long as again, go back to my optimization comment, as long as that optimization can be utilized throughout the system, that will allow for more value to be certainly created for the producer, maybe for the shipper. You're seeing other new type firms participate in markets now. The merchant firms, merchant energy firms, are heavily involved in LNG, and certainly even some of the firms in China that are involved in distribution of gas throughout the country have grown tremendously. So a big user of LNG for sure, and I think that will create value and opportunities in the Asian region for optimization of the portfolios, but also more value for everybody in that chain.
What's the next step for Abaxx?
Yeah, it's a great question. We certainly are on the road to our launch. As I mentioned, we announced our first clearing firm formally on board today. We're working with others to be on board before we launch. The marketplace, as I said, continues to come to us with new product ideas. Probably so much, it's quite an refreshing, I think, and validates our model. Building the clearinghouse was the right thing to do. We could have outsourced clearing, and we looked at that back in several years ago, but we felt that spending the extra time and money on our own clearinghouse would bring the opportunities to address issues in the marketplace for new products. And I think that's really what we'll be focusing on. We'll also be looking at adding better technology to the existing clearing system globally. If you look at clearing, and my experience in clearing goes back to early 2000s, during my time at the NYMEX, clearing systems, and even during my time at Goldman on the clearing side, clearing systems haven't really changed dramatically. That's maybe a good thing over the years, but truly better technology has developed between the 2000s and now that could potentially add more efficiencies, add more margin efficiencies, as I mentioned earlier, also adding cost efficiencies and even better risk management policies to clearinghouses and exchanges. And that's something that I think our technology, we have that opportunity now, given we're at the starting point versus all the legacy systems that exist on exchanges and clearing firms, for us to develop new better technology for managing risk in our markets.
Biggest opportunity going forward? You kind of touched on it, but what if you were to put your finger on one aspect of the business, what do you think is the biggest opportunity?
Well, I think we're in the risk management business, right? And that's what exchanges and clearinghouses do, and particularly clearinghouses. And again, I think the technology side was an opportunity for us to utilize or roll out into the marketplace when it's ready. Better technology, better systems, and more efficient use of capital. I think that's really where the biggest opportunity for us is to help the marketplace find better ways to utilize their collateral that they're posting in marketplace that are just totally inefficient. Yet you want to do that without adding undue risk into both the clearing firms and the exchanges. But we think there's a way of doing that through better technology.
Well, that's almost an hour. I think that's a great summary. Your thoughts on Abaxx and what the business is about, a little bit about LNG. I really appreciate it.
Thanks for having me, Trevor. I really appreciate it.
And all your Goldman colleagues will be excited to hear your opinion.
I hope so. Thanks.
Well, in the formal conversation there. Hello, listeners out there. Thanks for checking out the podcast. Hopefully the episode provided some insights. If you enjoyed the show, check out trose.ca where more episodes are yet to come. You can also subscribe to the podcast where your token of support is much appreciated. Until next time, happy coffee drinking.